So today, welcome back to my YouTube channel, and I'm going to be taking you through some guide to day trading for beginners. Yes, you are right, the thumbnail wasn't a clickbait, so let's get straight into it. So for people who are beginning to trade, I believe you have already done your research well in terms of knowing what forex trading means. So just in case you didn't do, let's do it again. So let's see what Google has to say. My own personal definition of forex simply is it is the buying and selling of currencies online. We call it OTC. Like initially it used to be physical, but currently it's done online. You can do it from anywhere in the world as long as you have your stable internet and a good laptop or smartphone. You can trade, you can do the forex exchange or the foreign exchange. So in forex we have different types of traders, but before that, let's do first what is foreign exchange. So let's see what Google has, the definition that Google has for us. It refers to exchanging the currency of one country for another at prevailing exchange rates. Let us take a close look at the meaning of foreign exchange. Yeah, okay, that is a vague explanation, but it's just good because the definition doesn't even have a lot of importance. So my own definition in terms of forex, when you are here, you want to day trade, you want to profit from the price discrepancies between two currency pairs. So for example, you might have your euro USD. Let me do this real quick. All right, so I'm gonna add this to my favorites there. Okay, it's already there. So I'm just saying that you can have two currency pairs. So the two currency pairs, you want to benefit from the exchange rates. So you have something like euro USD. So the currencies here, we have the euro and we have the dollar, the US dollar. So you want to buy or sell, the difference in price is what you want to profit from. So this forex market has been built in such a manner that a small movement can generate a very huge amount of money. You get me right? So for example, a pair is moving upwards, right? Let me give you an example here, just of a sketch, something sketchy. A pair is moving upwards in this sort of manner. So we are assuming that this is the euro USD, it's buying. So it started from here, it went, came back a bit, went up. So when it is moving up, we say that it is buying. When it is moving down, we say that it is selling. When it is moving up, we say that it's buying. Buys are also called long. When somebody says I'm going long on this pair, it means that that person is buying that pair. You understand? When somebody says that they are going long, it means that they are buying. When they are going short, it means that they are selling. So those are some of the simplest descriptions we can say. When somebody says they are buying, they are simply going long. Yeah. When somebody is selling, they are going short. So this is what it means. To buy means to go long, and to sell means to go short. We buy when the market is moving up, and we sell when the market is moving down. So in order to know when to buy and when to sell, you need to have a proper strategy. You need a proper strategy that will help you know that the market is about to sell or the market is about to buy. So those types of strategies, they are endless. There are very many different types of trading strategies. First of all, let me demonstrate to you here. We have the retail trading strategies. The retail trading strategies, these are simply strategies where we use the trend line breakouts and stuff like that. Then there are also people, and even I myself at times I combine these SMC strategy. This is also a trading strategy where people trade order blocks. So it's just about somebody. If you're a beginner, I'm advising you to start with the retail trading strategy, then try to go for the SMC trading strategy, so you know that which one suits you best. You need to know which trading strategy suits you best before you actually get to decide what exactly are you going to be doing in the markets. So if you are going to be trading retail strategies, check my past videos, because I normally teach how to time those trend line breakouts and those retests and things like that, the key zones, the psychological levels. Those ones are very crucial. They help a lot in terms of knowing when the market is ready to buy and when to sell. You know, the problem is that many people, they think that as long as the market is moving, they have to be executing a trade, and that is exactly where they go wrong. The market can do anything. It can buy and buy and buy and buy, but you can't just get in the middle of the movement, because you need to have an edge on the market. Let me explain. For example, you've already found the market buying somewhere like here. You know, instead of just getting in there, you need to understand what is your risk and what is your reward. So some people, they decide to just get in the middle of nowhere, and then the market goes against them, and then they lose the money. For example, let me give a good example here. You can see that the market was buying. Somebody might decide, oh, I can see that the market is buying, let me enter buy position here, without understanding what their risk is and what the reward is. So many people end up making mediocre trades, then making losses, then they call forex a scam. No, forex is not a scam. You just need to have a proper edge. You need to know when is it safe to buy for me. What do you need to look at? What factors need to align before you actually execute a trade? So the factors that you look at when you want to execute a trade, they are called we call those confluences. We call that confluence. You need confluences. Confluences are simply reasons as to why you are buying. For example, you are trading something like a trend line breakout. So in order for you to be sure, I normally tell people you need at least 3 to 4 minimum confluences before you make a trading decision. For example, you might be observing here that this market is on a bullish momentum. So what tells you that you are ready to enter the market? The first confluence could be the fact that this was a first touch, second touch, and then at the third touch here, okay, the market bounced a bit, then came broke out here. Now by the time the market is breaking out, that is your first confluence, because there's a trend line breakout. Now you need also something else. You need something like maybe a psychological zone or a key level where the market is bouncing at. So for example, for me, I would have said that, okay, the market has broken out, it has retested this zone. So the breakout was the first confluence, then these retests here, these lows, that is a key level. So I know that once the market has made this bullish engulfing, that will be like a third confluence, because the market has closed with a very bullish momentum candlestick, and we have closed outside the trend line. We have already tested these lows here, so I know that the market is ready to go up. So you will have probably looked forward to get long at that particular point and have your stop loss there. So like for example, you will want to get in there, your stop loss just below this low, and then overally, maybe your first take profit zone will have been here, because this particular point, you understand that this is some sort of a key reversal level. So you want to see if the market will break above or it will hold. So if that resistance holds, you just want to take your profits here, or if you want to actually risk taking your profits, maybe to take profit 2 there, all the way there, you'll actually lock in your profit somewhere there. You move your stop loss to break even. So those are confluences, basically the reasons as to why I decided to buy here, the factors that aligned for me to say that I want to take a buy. That's what now we call confluence, you understand? So basically I was just explaining confluences for those who are beginners. So when the market is moving up, right, when the market is moving up or down, we measure the movement in terms of pips, you understand? Let me introduce you to a term called pips. So when the market is moving up or down, the difference between where price was initially and where price is currently, we measure that in terms of pips. This is simply the difference in the price movement. That is what we call pips. For example, I want to teach you the pip concept from the, let me do it from the Euro USD chart. At least it's easier to learn how to calculate pips before on Euro USD before going to things like gold, US 30, NAS, and you understand those indices. So let's take a good example here. Let me just put it on the hourly time frame. I want you to understand something, guys, just a bit. So as you can see here right now, yeah, the market has been moving to the downside. So let's assume you are somewhere here. Let's assume you are somewhere here. Yeah, let's say that you saw that the market has broken key loss. Then you are waiting to enter your cells. So by the time you're deciding to enter your cells, just have your points like that. So let's assume that you've decided to take your cells from this zone here. You've seen that the market has broken out and it's kind of like on a bearish momentum. So let's assume you chose to go in there, and then your stop loss just above this high. Then you are looking forward to benefit from this move to the downside. So this point here, you understand that price, where was it starting at? Let's use this 1.1209. So you wanted to get in at that point 1.1209. That is where you pressed your sell. You entered your sell trade. You wanted to target maybe 1.11287. 1.11287. So this move from here to here, we are going to measure it in terms of what we call pips. So those pips, yeah, those pips, we measure them in this manner. For this Euro USD, we will take 1.12. Okay, we said that our entry was here 1.1209. So let me just do this math real quick here, so you all get to see. So we'll do 1.1209, then we'll do minus 1.11287. So the difference in this is what will be the number of pips. We don't use the last digit because the last digit is called the pipette value. You can see it's to 5 decimal places, so we'll just consider the first 4 decimal places. This last value is very insignificant, hence we call that a pipette value. So we are going to take that and do the maths. Let's see what we'll be getting. 1.1209, then minus 1.11287. So we are getting something like, let me see if I'm right, 1209, yeah, minus 1.1128. So the one is constant, so basically we'll just do 1209. I'm ignoring them because obviously 1 minus 1 is 0, so I just want to make my work easier by doing the 1209 minus the 1128. So you'll get 81. So that means that we have 81 pips. So you know that the market has moved 81 pips. Now, how do you calculate your profits in terms of these 81 pips? How do you know your profits or whatever you are making? Also the loss, that is just the same way you calculate. For example, here you can see that stop loss is at that point of 1.1230 and we got in at 1.1209. So we'll just do the 1230 minus 1209, which will be getting about 21, I think. And this is why I like using this position size calculator. If you have trouble calculating pips, I want you to look at this zone here. You can see at this red zone, they've indicated there 21.5. Those are the number of pips that you are risking. That is now your stop loss. Then 79.5. That is basically the pip move from the entry. You can see down here, target, yes, 79.5. So it means that this is where you would want to be taking your profits at. So this point is what we call the take profit zone, and these are 79.5. I calculated, I got 80 pips. I think it's just a difference of some pipette values which are minute, so it's like 81. Yeah, I got 81 pips. Depends because I used this 1.1128. I think this one used 1.1129, so no much difference. This 81 is the pips different. So if you don't want to be doing those crazy calculations, you can just be using this not stop but position size calculator. It shows you how many pips are you risking and how many pips are you going to make. So this position size calculator is a tool that is available on TradingView. For you who have laptops, you can access TradingView. This tool is there available for you. For those using smartphones, it's a bit tricky because again, I don't know, MT4 doesn't have something that calculates these pips for you automatically. So yeah, if you don't have TradingView, I suggest you just go the normal way and learn how to do those calculations manually, so you know exactly how to calculate your risk and reward. So I was saying we are measuring this move in terms of pips. Now how to know the profits you are making? Yeah, so you'll come here and do something we call the lot sizes. Your profits are going to depend on your lot sizes. Again, remember these lot sizes depend on your account size. The lot sizes you're using are going to depend on the size of your account, because let's say you have something like $100. You cannot execute a one lot size on a $100 account. But let me tell you first about the lot sizes. So we have mini lot. You have something called a mini lot, which is of values in terms of 0.0 something, could be something like 0.01. Then we have a micro lot. The micro lot could be 0 point something, so like 0.1 there. Then we have something like the standard lot. We have the standard lot. The standard lot is 1 point something. Anything above, I think one is the standard lot. So this mini lot, let me just rectify here, it's a micro lot. So micro lot for a 0.01 lot, mini lot, it means that you're going to be making $0.1 per pip. Then for each micro lot, it means that you are going to be making $1 per pip for every micro lot that you've placed. Then for each standard lot, it means that you're going to be making $10 per pip. So this is how you calculate your profits. So these lot sizes are going to depend on your account size. Lot sizes are going to depend on your account size, because let's say you have a $100 account. $100 account, you can execute lots like mini lots, 0.01 lots, maybe 0.1 lot. But now for a 0.1 lot on a $100 account will be over risky. So all these things, they go hand in hand with leverage. I'll make sure to create another video where I talk about leverage and things like that. So basically today, summary, what I want you to grasp if you are starting day trading, I want you to know that the price movements, are measured in pips. That is the unit that we use to measure price movements. Also, I want you to know that when the market is going up, let's just say when the market is buying, you are going long. When the market is selling, you are going short. Also, I want you to know that trading strategies, there are very many trading strategies, but the key that we know are the retail trading strategy, then we have the smart money concept. We normally call it the SMC strategy. So these are some of the strategies that I'm advising you to go and look into. I'm advising you to go and look into these trading strategies because they are the basics of where you'll know what you're doing in the forex market. So I also want you to know that we have something called confluences. We say that the confluences are factors that are agreeing as to why you are going to take a certain position, either a buy or a sell. So those are the key things that you need to know. Then something else that you should look at is how to calculate the pips now. I want you to go and look at those because they form the very basics of where to begin as a trader. Also, something else that I want to talk about today, something that is of great importance, but some of you may not know, is you need to figure out what type of a trader you're going to be. You understand? You need to know what type of a trader you're going to be. So let's look at the types of traders that exist. Types of traders. Number one, we are going to talk about scalper. Number two, we are going to talk about an intraday trader. Number three, we are going to talk about a swing trader. Then number 4, we are going to talk about an investor. So these are the major 4 types of traders there are. So a scalper trader is simply a trader who gets into the market for a few minutes then gets out, and usually they normally use the smaller time frames to trade. They trade from the smaller time frames. So if you want to look at this trading thing, you are curious about becoming a day trader, you are passionate about becoming a day trader or a trader, let me say a trader, you want to be a forex trader, you have to understand what type of trader do you want to be. Do you just want to be the type of trader that gets into the markets for a few minutes and then leaves, or do you want to be the type of trader that stays in a position for long or a few days? So these are the types of traders you want to know. Which one is your style? Which one suits you best? Which one are you much more comfortable trading with? So for a scalper, this is just, we've said, a trader that trades within short time frames. Let me say smaller time frames. When I say smaller time frames, I simply mean smaller time frames. When I say smaller time frames, I mean somebody that can be in the market for like 5 minutes, 15 minutes, 30 minutes, sometimes even just a few hours. So those are scalpers, quickly in, quickly out of the market. So the only disadvantage about being a scalper is that scalping is going to need you to risk a huge amount of money so you can make a lot of money. Normally scalping doesn't have a good risk to reward ratio. Basically these types of traders, they normally want to make something like 1:1 RR. You're simply risking $30 to make $30. So those are types of scalpers that exist. Some can go even 1:2, 1:3, but the amount they're risking is huge, so that they also make huge amount of money within a very short period of time. Then we have these types of intraday trader. An intraday trader is simply a trader who executes multiple positions within the same day and lets the trades run for some hours before getting out of the market. So that is basically an intraday trader. Then we have a swing trader. Swing trader is somebody who can take up maybe a trade today. Maybe they enter a sell today and they hold the trade for a few days, maybe 2, maybe 3, before they decide to get out of the market with some profits. So that is an a swing trader. That is a swing trader. We say that an intraday, let me just make a correction here. We say that an intraday trader is a type of trader who makes multiple positions, executes multiple positions within the same day and lets them run for a few hours, then goes out with the profits at the end of the day, or even losses. Then a swing trader is one who lets their trades run for a few days, maybe like 2 days, 3 days, sometimes up to a week. Those are swing traders, or sometimes can let it run for a week or 2. Then we have an investor. An investor is simply somebody who can let their trade run for months or even years. So for this type of trader, you need to be very patient, because you will collect your profits after a very long period of time. So that type of a trader is an investor, basically. So those are the types of traders. You have to assess yourself and see which type of trader do you want to be. Do you want to be a scalper, which carries high risk, so it means you need to have high accuracy? Or do you want to be an intraday trader? Do you want to be a swing trader or an investor? Once you've identified those types of trading systems, you'll be able to figure out what type of trader you want to become. So with all that being said, please go and review this information. On the next video, I'll be covering about the types of pairs to trade, the times to trade. Let me just highlight somewhere so I don't forget. I just make this an assignment for myself. So I said next lesson we are going to be looking at what pairs to trade as a beginner. These are simply pairs that will help you start making profits in the market while understanding it better. You know, there are pairs that you can't be a beginner and start trading things like gold. Like, you'll make a lot of losses and you'll hate forex for no reason. So that's why we'll talk about what pairs to trade as a beginner. Also, I'll be teaching you about what's the time to be trading as a beginner. Then probably I'll give a brief introduction on how to read candlesticks. So yeah, I'll give a few lessons there on these key topics, because I understand that most beginners need to know the types of pairs to focus on, the time to be trading as a beginner, but that applies even if you're an experienced trader or an intermediate trader. It doesn't solely depend on if you're a beginner or not. It's just for everybody in general. Then introduction on how to read the candlesticks, because you know these candlesticks are telling a story. If you're able to understand these candlesticks, then you're in a better position to profit from the market as compared to if you don't understand the candlesticks. So these are what we call candlesticks, and I'll give a lesson on them on the next video. So until that time, guys, stay put. Thank you for watching.